In today's video, I'm going to show you a way of confirming market manipulations using the absorption and initiation patterns in the footprint chart. If you don't know how the footprint chart works, please watch my recent order flow course here in the channel. I'll leave the link in the cards or video description. Without further ado, let's jump right into it. Here we have a 1-hour chart of Euro futures, recalling that volume data is more reliable in futures because they operate under centralized exchanges. You can use volume data from futures and trade Forex directly if you want. So whenever price pierces a significant low and closes above it, like we see here, we have the potential for a market manipulation, which in this case is also called a bear trap. In this case, we can already know what happened afterwards, but let's investigate the signs that led to the confirmation of this bear trap using the footprint chart. When we see a candle like that, we can only assume that sellers are being absorbed by buyers by looking at its shape. This is where the footprint chart comes into play. The footprint is like putting candles on an X-ray machine. We can see what happened with the volume action across the different price levels within the candlestick. Let's observe the footprint of the candle that encountered the support to see what happened with greater detail. We can see that price closed above a stacked imbalance in the bid. This is the classic sign of selling absorption. Bid imbalances generally mean selling power, so price should close below them in order to confirm the selling power. When price closes above the bid imbalance, the interpretation is that sellers are being absorbed by more powerful buyers. One extra detail here is that the bid imbalance is stacked, which is generally stronger than a single imbalance. That means that the buyers absorbing the sellers are more powerful than they would be if this was a single bid imbalance. If we look at the ask column, we can see a couple of single imbalances as well. Notice that price closes above both of them. This is the classic buying initiation pattern in the footprint. Ask imbalances generally mean buying power, so when price closes above them, we have confirmation that buyers indeed have directional intent. Notice how this reading of the ask column perfectly complements the reading in the bid column. At the same time that sellers are being absorbed, buyers are showing signs of power. Notice also how there is an ask imbalance exactly at the level of the support line, which is additional evidence of the presence of buyers due to that major support. This information can only be seen like this by observing the footprint. Another important detail here is the delta. A positive delta means more volume in the ask, meaning more buying aggression, which agrees with the general tone of this candlestick. Now, a lot of times, these patterns will appear simply because price is reacting to a support line, as is the case here. This is why it's always wise to observe what happens in the next candle in order to confirm the market manipulation maneuver. Let's take a look at the footprint of the next candle to see what kinds of patterns emerged. For those of you familiar with the footprint patterns, this candle screams buying power. Notice that we have two big stacked imbalances in the ask, and price is clearly closing above them. This is a very strong buying initiation pattern. We have a smaller stacked bid imbalance, but price is closing above it. In other words, in this candle, sellers are still being absorbed, and the buying initiation got a lot stronger. Notice also that not only delta is positive, ask volume is almost twice as big as bid volume, which represents a lot of buying aggression. These are the signs you need to confirm the bear trap, and you can take a long trade at the open of the next candle with a stop below the bear trap low. If you wanted to be bolder and take more risk, you could open the trade after the absorption and initiation patterns of the last candle. That would yield a greater risk-reward ratio, but you would be subjected to a higher risk of being stopped out. As usual, there are no solutions, only trade-offs. As you can see here, price went to the upside after the absorption and initiation patterns in the footprint in response to the bear trap pattern seen in the candlestick chart. Let's look at another example, but now in a bull trap pattern, recalling that Richard Wyckoff was already talking about market manipulation and smart money between 1910 and 1920, so it's definitely not a new idea. In the same 1-hour chart of Euro futures, we can see an example of bull trap. Notice how price moves in the direction of a significant high, pokes the high and closes below it with a bearish candle that apparently denotes high selling power. This is the moment we deploy the footprint chart to confirm if this candle indeed means high selling power. By looking at the footprint, we can tell that this is a different situation than the example we saw previously. In this case, the moment price touches the resistance, it immediately transitions into a selling initiation pattern without going through the absorption first. Notice that we only had bid imbalances, and we have price closing below all of them, which is the classic selling initiation pattern. Recall that bid imbalances mean directional selling aggression when price closes below them. A couple of interesting details here is that we see a single bid imbalance right at the resistance level, and we also see a stacked bid imbalance. The bid imbalance at the resistance and price closing way below it means that powerful sellers were already waiting at the resistance, so to speak. Price closing below the stacked imbalance is also a very strong sign of selling power. The negative delta confirms the overall bearish bias of the candlestick, which is exactly what you want in a selling initiation. And we also see price closing below the fair value area. In other words, price closing below the fair value means that after touching the resistance, the market became imbalanced to the downside, and now price entered price discovery mode. The result here is obvious. Price ends up with a massive drop. Still in the same chart, I want to talk about something that is confusing young retail traders who learn how to trade on social media and end up falling for cult-like mentalities. Notice that right after the bull trap we just talked about, we see price reacting to what people now call a fair value gap, as you can see here. If you don't know what a fair value gap is, watch my video called Learn ICT Concepts in 30 Minutes. You don't need to spend months and years to learn something that is actually very simple and just reinterpretation of old ideas in technical analysis. People who know what fair value gaps are but don't know how order flow works indeed think that price reacted there because of the fair value gap. Let's take a closer look here and see the footprint of the area where the so-called fair value gap occurred. Once we see the footprint of the candle where the fair value gap occurred, we can see a massive stacked imbalance in the S column and price closing above it, which represents strong buying aggression in that level. If you watched my last video, you know that stacked imbalances like that can be used as support or resistance. That is what makes price create that retracement to the upside after the bull trap we saw previously. By the way, if we look at this scenario in terms of the footprint chart, you can see that the reaction occurs precisely at the upper limit established by the stacked imbalance in the ask, not at the limit of the so-called fair value gap. What I'm trying to say here is that the stacked imbalance in this case represents a price region where liquidity was low, and therefore buyers could produce a significant move to the upside more easily. More importantly, you must understand that these ideas originated in the methodology of Peter Steidlmayer, a trader at the Chicago Board of Trade in the 1980s, who developed the market profile approach. According to Steidlmayer, areas where price moves faster like that are a result from price trying to find fair value. You can see how the idea was renamed as fair value gap. In summary, all this talk about balance and an imbalance, efficiency or inefficiency, fair value and liquidity is originated in Peter Steidlmayer's methodology, which was later developed by James Dalton. It's important that you understand the origin of the ideas that you encounter so you can stop falling for cult mentalities and conspiracy theories on social media. Again, if you are not sure how order flow works, please watch the free course I have here in the channel. In fact, I have a whole playlist of free training courses with over 16 hours of content. If you want to learn the best about price action reading, please check out my courses and ebooks in my website fractalflowpro.com. If you have any questions, you can send me an email at support@fractalflowpro.com. If you like the content I produce, please help support the channel by clicking the like button, subscribing to the channel, activating the notifications, leaving your feedback in the comment section, and sharing this video with your trading community. Thank you very much for watching, and I hope to see you in the next videos. Take care.